Nothing we say is investment advice. Please pause on all 3 pages of this disclaimer and read it.
Okay. Hello, everybody. Nick Petruzzello, Wednesday, May the 6th. This is the BAM Trading Markets and Crypto Zoom. So for the BAM members, the Brotherhood of Ancestral Masculinity members, I go ahead and give an hour of my time so people can learn about trading, markets, and crypto. And I was just kind of chatting with Reagan here. And Reagan, you said you had real estate finance background. Is that kind of where you were experienced in any kind of markets?
Yeah, that would be the professional experience.
So with that, I mean, you have an understanding of markets, right? And I think you said you had an education in finance. So your comment was the stock market is a casino, and it's true. So the way in fact, I just had this conversation like an hour and a half ago. If I could sit you in front of a slot machine, right, and I could give you $1,000, and I told you that you're allowed to bet $20 at a time, and that the slot machine will pay double or nothing, right? So you either lose it or you double it, and you actually are going to bet 2% of that $1,000. So as the $1,000, let's just say it became $2,000, you could bet $40 at a time, right? Mm-hmm. So if I told you those were the rules, and then I told you that the slot machine pays out 55% of the time, what would you do?
Just keep hammering.
Just hit that button, right?
Yeah.
That's what we do as technical traders. Okay. So it's not about like, oh, how is this company going to do? Or I like this stock. I like, Jeff Bezos said this. None of that shit really matters to us. And whether you're trading stocks or crypto or forex or anything else with a candlestick, we actually have information on the screen that tells us what we need to know to take bites out of a move, whether that move is up or whether that move is down. Okay. So basically, if we use data on the screen in a predictive model, a probabilistic model, we recognize a pattern where if we do the same thing every single time, we're going to win 65% of the time. And it's better than double or nothing. Maybe it's like a risk to reward ratio of say 1.6 to 1. So for every $100 you put in, you're pulling out 160. Mm-hmm. Well, that's better than the the slot machine example that I gave you, right? Mm-hmm. Well, that's what we do. So it's a little different than playing the casino and hoping that your company does well, and then Trump says something on a Monday and you lose 10% of your net worth, and it's not really about that. So it's a whole different game. So what I'm going to do is share my screen so you can see my latest algo that I actually built last week. It's an iteration on other algos that I've built. So it's not something that I built all last week, but I have sort of a basic understanding of some of the tools that I use. I should say more than basic. I have an expert understanding of certain tools. And let's do this here. Okay, so you should be able to see a screen moving around right now. Is that correct?
Yep.
And so can you see the little arrows?
Yes.
Green and red? Mm-hmm. So that's the algo. It's my latest version of an algo that I use. And you can see they're not all winners, right? And this is a 30-minute chart. This is the euro versus the dollar. So if I were to go short here, I would lose because the price went up. So that's a loss, right? But if I went short here, it's a nice win, big win. And then if I went short right here, it's still a win. I might lose, I might win. We could just call that like a nothing. We won't count that either way. Mm-hmm. It just depends. It's too hard to tell which way that would go. We could even count it as a loss. I'd be happy to be conservative. We have 1 win and 2 losses. Here's a win, 2 and 2. Here's a loss, 3 and 3. No, 2 and 3. 3 losses, 2 wins. There's a win, 3 and 3. I'd say 2 wins right there. So now we're up to 5 and 3. 5 and 4. You got 5 wins, 4 losses, and a nice big win here at the end. So you got 6 and 4. 6 wins, 4 losses out of 10 trades. That's 60%. That was loud. That's 60%, right? Again, 6 wins, 4 losses, 60% hit rate. But the cool thing is that the way that I win on these bigger trades is like a 3 or 4 to 1 risk to reward ratio, right? So, golly, man, everybody in the world wants to text me in the middle of this thing. Let me go to a do not disturb mode, which is something I should have done in the first place. Okay, I'll do it for an hour. And we'll shut off our trading alarms because this is a terrible time of day to trade. I won't be taking any trades. Okay. In fact, I'll just trash these. Well, I'm going to start fresh here. Let's go ahead and pause all. And I will delete all. Okay, so we shouldn't have any more interruptions. Apologies for that.
No worries.
Okay, so where was I? So we have 6 wins, 4 losses, but each win is going to be a bigger win than the loss, right? So for example, if I'm doing a range trade, then then I would be taking my profit based on that range in this case. So I might get into this right about here, and I might have a stop loss pretty high. It'd be a good solid stop loss, and that's like a 2, better than a 2-to-1. So we'll say a 2-to-1, right? This one is probably going to be at best. I didn't count this one. I count it as a loss. Is this a win? That's a win. So I might not do that well on this trade. I'd have a stop loss down here. Take profit would have been at least 1-to-1. I might have just broken even on this, so I won't even count that as a win. So now we're at 5 and 4. So here's a loss. So now we're at, what is it? Well, we already know that. So we have one big win at 2-to-1, another that we didn't talk about. Here's a win. I would win this one. I probably would I'd have a target up top here. That's a 1-to-1, actually. This one here, I bet you I'd yank. This is not a really great back test, but I'd yank a good 1.5-to-1 out of that, 1-to-1 on the next one. And then this one here would be like a 3-to-1 easily. Like I probably would get in up here, and let's just call it, to be safe, a 2-to-1. So I have, like, on average, my risk to reward ratio, the amount I'm winning versus the amount I lose, probably sitting. Hey, what's up, Larry?
How's it going?
Doing good. How you doing, bud?
Doing well.
It's roughly going to be like 1.4-to-1, So I'm winning really 5 trades. And I'm losing 4, and I got a 1.4-to-1 risk to reward ratio. So 5-to-4 on a double or nothing, you're still ahead a little bit. We boost it up to a 1-to-4 risk to reward ratio when you're winning more than you lose. Now it starts to get profitable, right? It's not like you're taking 10 trades to really win just one. You're adding another 40% to those wins. So this is why when you can, recognize a pattern, and then you go and you test it to develop a probabilistic model, that you're going to win 63% of your trades. That your average risk to reward ratio is going to be 1.4, and you can actually predict what your outcome is going to be. Right? That's your back testing model. And then you got to go ahead and trade it. And you trade it for small amounts of money. Right? We call it forward testing. I'm going to go ahead and mute you, Larry, because I hear a little noise coming from there. And once you forward test it with small amounts of money, you've cut down on the risk. And that, you're like betting a quarter position size. So instead of $100 or $1,000, you're betting 25 or 250, right? Money you can afford to lose. And then for sure, you have a much closer model to what your risk to reward profile. It's called expectancy, but you have a risk profile. You have a probabilistic model of how much you're going to win. Now, if you're like Larry and you're built of, you have nitroglycerin for blood, you're on fire, and you build your algorithm in 2 or 3 weeks like Larry did, because you're an absolute beast, then you just, get to forward test. And then that takes a while because you got to wait on the market to actually provide you those opportunities, right? Because now Larry works with me over at Algo Factory, so I already know how he works. Probably the most dedicated member of the group in that regard. Between you and Mikko, as far as building out. But that's how it works. So this isn't, you don't care what this stock's going to do. You don't care what this and that and the other. You just use the information like I talked about. And that information isn't just these arrows. I built that, but that information looks like this at the bottom of the screen, right? It's just indicators. They're based on math. They just are mathematical formulas. They give you an idea of maybe like the trend in price, or price is going to flip around on you. There's a lot of different things. There's like a million different indicators. There's ones that people just make up on their own, which actually that's what these triangles are. I made this one up. I just mishmashed a couple others together and then tweaked them. And I do it over multiple time frames. So I use all this data on different time frames to do it. It's a bit of a predictive model based on a lot of trend data, right? So that's what we do. It's what I do. So, if you're interested in trying to develop like another income, it's not something I would expect to make a lot of money at right away. Most people who don't have a coach of any kind, the ones who are successful, which are less than 10%, they tend to have a coach, right? The ones who just like try to feel it out, without any kind of help, they're very low percent success rate. But even the ones with coaches, like if you take all the different traders, coaches or not, and you like track them, especially when it comes to like forex trading, it takes them 4 years to become profitable. So it's not something that like you could just plug into your AI and say, hey, make me a trading plan and it's going to be successful. And because if you could do that, then that's what everybody would be doing. Like there's a whole world to it, right? So it's different than what people think. So I'll take a break there. See if you guys have any questions right now. Reagan, do you have any questions?
What like platform is it? What are you looking at?
This one's called TradingView. I think there's a free version. It has a lot of limitations. There is a very inexpensive version that has limitations. I have the second most expensive. It's about $1,000 a year, but I get it at 70% off every year. Like I wait for Black Friday. You can get the cheap one until the sale comes around, and when the sale comes around, you capitalize and get the better one.
Okay.
Larry, you have any questions?
Yeah. Can you explain Fibonacci retracements and how to use the retracement tool?
Great question. Okay, so a Fibonacci retracement tool is based on numbers that occur in nature. So if you look at like plant life, and by the way, guys, how's my sound coming through? Is it good?
Yeah, it's good, man.
Okay. If you look at plant life, I'll show you something here. Let's just say Fibonacci numbers in nature. These are all Fibonacci patterns. Sunflower seeds, shells, pine cones. Just there's a bunch of places in nature where Fibonacci numbers exist, and no one really understands why, but it's there. It's there in nature. So for some reason, whether it is a self-fulfilling prophecy, yeah. If it's for some reason, whether there's a self-fulfilling prophecy or if it's some magical thing, Fibonacci numbers work in trading. Did you guys see that screen or no?
Yes.
Okay. I just, when I'm using different platforms, I forget whether I'm doing it right. So in trading, the Fibonacci numbers are very specific, right? Now, the way the market works is it goes in impulses and then retracements. That's how it works. Impulse, retracement. And a lot of times the impulse can flip directions, and then you have a retracement and an impulse, right? That's how that works. And these don't have to look like this. We can look at real examples here in a minute, but that's how the market works. Okay, so how far back the retracement goes is where Fibonacci tools are useful, okay? So here is a Fibonacci tool, and ignore the 272 and let me just adapt this to answer your question. We'll get rid of this one, that one, this one. That should do it. So this is a Fibonacci tool. Let me make this a little thicker for you guys to see.
Is that 0 or 100 at the top?
0.
0's at the top. Okay.
Well, that's because of the way that I did it, right? If you
you
start
run
from
like
top
one.
to bottom, it's going to be the opposite. See, then you'll have 1 at the top and 0 at the bottom, right?
So the one on the left is for a bull trend, correct?
Correct. So if price makes an impulse, price makes an impulse up, it's going to pull back a certain amount. So what you do is you overlay the Fibonacci tool at the beginning of the impulse, and then you go to the very top. And the probability of it hitting any of these levels is relatively high. And the golden ratio is 0.618. And the golden ratio exists in nature. It is the golden ratio in nature. If I'm not mistaken, hip to waist ratio on a female, what drives most men mad is a 6.8 hip to waist ratio. And I believe 6.8 is from joint to joint to joint on your finger. Like it's really something else.
No, I thought that was men.
What's that?
I thought that ratio was to men, shoulder to waist.
It might be shoulder to waist. Yeah, I don't know. It might be both. Whatever the case may be, though, that golden ratio, for some reason, it just works in nature, right? And apparently it works in trading. So, I mean, professional traders, real traders, I use it. It's not just some made up thing, unless it's a made up thing and it's just a self-fulfilling prophecy. And it really doesn't matter which one of those it is because it works in trading. So if it pulls back to a 382 and then continues upward, it's probably going to be a very strong move up. So the less the pullback, the stronger the extension.
Okay.
Right. So if you get a pullback to the 618, it may not go quite as far. It's not going to be as strong of a move. And if you get a pullback to the 786, then it's a weaker move to the upside. You have a lesser chance of breaking this high or even making it to the high, right? So the farther the pullback, the weaker the move. The lesser the pullback, the more it wants to go up. And that makes a lot of sense because you have this peak, the sellers take some profits, but the buyers kick in real early. The sellers wear out because there's not a lot of sellers. The buyers are just lined up and they buy the shit out of it, right? So if it pulls back a lot more, it means there's a lot more sellers and a lot less buyers, or they just aren't interested until it gets to this level.
Can I ask a more in-depth question? Or
ask away.
Okay. Can you go to the Euro USD at 30 minutes, or go to the 1 hour and at 4 o'clock this morning?
Sure. Let me just put my other ratios back on. I also use this as an extension tool, so I just had to fix it up. All right. What am I doing?
So 1 hour time frame, Euro USD, 4 o'clock this morning.
Okay, I got to go to a different chart. It's AI tester. We'll go to a single page. We'll go to the 1 hour time frame. You said what? I'm sorry. What time your time?
4 a.m. Central Time.
4 a.m. for Euro Central, so 2 a.m. Pacific, 3 a.m. Mountain. Today's Wednesday, right?
Yeah, today's Wednesday.
Okay, so right here, before the Euro gets slammed down.
How are you? Yeah, so, okay, on that move prior to that, that was a bull move. It was higher highs, higher lows, correct?
Depends what time frame you're looking at. So if you're looking at this from, give me a second. On the stronger trend, it's bearish. It's actually lower lows and lower highs.
It's bearish. Okay.
See that?
Then that was my mistake.
Yeah, you gotta zoom out a little bit. Now, if you zoomed in and you're trying to trade like the 5-minute chart, you trade on the hourly, right? So you got to look at it from an hourly standpoint. When you're looking at it from the 5-minute standpoint, then you're going to think it's a bullish trend.
Okay, go where you were at. Can you go back to where you were at? Okay, so now right there.
This is the 5-minute chart. So if you're looking at the 5-minute chart, you're like, hey, look, this is a bullish trend. Higher highs, higher lows, and you're going to go long. But you didn't zoom out and look at the hourly trend. That might have been your mistake.
Roll to the right a little bit on the time. Let's break a structure right there. Where your cursor's at?
Like right here?
Yeah, so now that's technically bullish, correct? Because it's a break of structure there.
I mean, you got to break right here. If you're talking about the wider trend that we were looking at, this bigger trend, then this is the structure it has to break.
That's the structure it has to break. Okay, that's where I went wrong.
Yeah, because you keep zooming in. So if you're going to look at the hourly, then you got to look at the hourly, right? So the hourly, if we can find our spot here, the hourly trend, it looks like this. And, there is a certain subjectivity to this, right? There's a little bit of subjectivity to these, but in the end, you got to find higher highs, higher lows, or lower lows, lower highs, lower highs, lower lows, which is what this is.
Yeah.
To make it simple for you, like when you're in a downtrend, lower low, lower high, lower low. So if you want to break structure, then first of all, the end of the trend doesn't necessarily happen right here. Even if it breaks above this, your trend's not over.
Okay.
Then what you have to do is you have to make a higher low.
A higher low before the trend's broken. Okay.
And then you got to break this high. And now you know you're in an uptrend.
Okay. All right, that answers my question. Okay, then second part that I have for that. When you're looking for rejection at a certain level on a Fibonacci, right?
Correct.
What do you look for your confirmation?
I hate that word. And I even use that word. I use it and I don't like it.
All right, so comfort. What do you look for comfort?
Yeah, no, it's that's commentary. It's not judgment. A pretty good one, at least to scale down on the probability, is like something on the indicators. I mean, for me, it's just gonna, like, you're talking about a rejection where you think price is gonna flip around, right?
So say you're in a downtrend and you're coming on the golden 618, okay? And now
I got something for you. All right. So this is kill zones. Not the same kind of kill zone they talk in forex either. It's a different kind of kill zone. It's just something that's shop talk from one of my mentors. All right. So as price goes up, you draw a box. This is going to help you. This can answer your question. From the high to the low on the way up, right? You draw that box and you extend it out. Price is going to bounce somewhere in here. Okay. See that? So what you do is, let's just say it has not done that yet. So you're kind of waiting for it to go down to that area. You know it's going to hit that kill zone. You just don't know where it's going to flip around. You take your Fibonacci tool and you put it on the impulse up, and you see that your 618 and your 786 are in that box. And then what you do, this is how we used to do it in the old days. No indicators, just price action. This is how it's traded.
Can you draw that Fib retracement again for me? I didn't see where you started.
So let me help it this way. So we want to find out where this is going to pull back to, right?
Yeah.
Right. So we want to know where this is going to go and when it's going to flip around and go up more. Is that correct?
Correct.
So what we're going to do is we're going to see this line.
That's okay. So you go
that's
from
the impulse. That's the impulse right there.
Yes.
That's the impulse. So we draw our Fibonacci from the bottom of that to the top of that. I literally, I use this, see the gray line at the top, the 0?
Yeah.
That goes on the very top here.
Okay.
You see the 1 is on the very bottom right there.
Okay.
So.
And your kill zone is high to high?
High to low.
High to low. Okay.
So you see how it goes up from the prior extension, and then you have your pullback here.
Yeah.
And then it extends again. So you want to know where the next pullback is going to go, right?
Okay.
So this extension, which is an impulse upwards, that's the kill zone is going to be at the top of the prior extension and the bottom of the prior pullback.
Prior extension, prior pullback. Okay, tracking.
Okay. So your probability of price going down to this area is very high because two reasons. One is going to need the liquidity. The large players need liquidity to enter here and push price up. So all the liquidity happens where price bounces back and forth. That's where all the liquidity is, where most of the price action is, right? We'll do this on an actual move here in a few minutes.
Okay.
So this comes down and digs into the kill zone, and it's going to be anywhere in here. But you have your fib level, so it's either going to be here or it's going to be there. Now, the way that we used to do it, we would use price action. So if this was the 1 hour chart, right?
Yeah.
We would let price get down to this area, which I will mark here because we're going to need that to tell where we are. And then I would actually go down to the 5-minute chart from the 1 hour divided by 4 is 15-minute chart. So we'll go 18 in this case. But I go to a 15-minute chart, and I would look for some form of candle theory at either this Fibonacci level or that Fibonacci level. We would look for candle theory. Back before we really used indicators, right? We would use candle theory. So maybe a double bottom, that kind of thing. And that's how we did it before. Those were our, not confirmation per se, but those were our signals that price was going to turn around. We use candle theory. Well, now you can use indicators if you want. You can use candle theory. Candle theory is always quicker than indicators. And there's a whole entire class we could do on that. But what I will do is show you an example. All right, so let's we know the future here, so let's do this. Let's roll it back to where we don't know the future.
Now, what's the lowest time frame that you'll use the Fibonacci retracement tool on?
No, there's no limit to that.
Okay. I heard that the videos that I've been watching research said that the lower time frames, the probability drops. I didn't know how true that was.
Well, the probability drops on everything in lower time frames. Doesn't matter what tool you're using, because lower time frames have a lot of noise and they have big spreads. So there's just your probabilities are always better for everything on higher time frames. So let's go to the hourly. Let's get out of the replay guy here. Actually, we'll strike this. Leave hourly, and we'll get out where you can't see the price. We'll go way back. We'll put on the replay function, start new replay. We'll go right here. Okay, so we don't know what's going to happen. Price just broke out of a consolidation, more or less. And now we're going to look for a trend, right? Arguably, you could say that this is an uptrend, right? You have higher high, higher low, higher high, higher low. Now you have a higher high, and this is a nasty higher high. It's way higher. So what we could do is we know, or at least we think it's going to pull back. So we see enough up here in candle theory to determine that there is a pullback happening, whether we use candle theory or not. And we go ahead and impose our Fibonacci on this move. So the bottom of that was right about here, topping right there. Okay. Now, the prior kill zone is actually right here. I drew it just because I had already drawn the range, but let's look at it from that standpoint. So the kill zone is the prior high to the following low. This is where price is probably going to want to go. May not make it there because this is a pretty strong impulse, and it is what it is. But we have our fib numbers that we could simply use if it doesn't make it here, and it may not. I don't know. We don't know the future. So we're going to see if we see any clues on a bounce at the 382 or the 618, or if it goes all the way down to the 786 inside the kill zone. And things tend to want to go back to the kill zone because that's where all the liquidity is, price going back and forth a lot. And if you actually scroll back, you'll notice there's a lot more liquidity in this area from before. Mm-hmm. High probability is going to want to come all the way back down. But what we can do is we can hit play and see what happens. Coming down, and so far not coming down. Continuing up. Barely broke that high. Looks like we got ourselves a double top. So it's probably going to come back down now for real. Coming down. Okay, we're getting pretty close to this 382. So let's see what it does. It's grinding down. Now we're at the 382, and it bounced right off the 382, didn't it? Yeah. This is the hourly. Technically, it didn't quite touch it, but it's right there. Now it may do some more for us here, but right now technically that was a bullish formation, right? So if you actually were watching it live time, it didn't happen so fast. These are 1 hour per candle. You have time to react. You see price gets really close to there. You get a spinning top, sort of doji or, dragonfly doji, if you will. And then you get a couple more candles. That's a bullish candle. After that, already that's a bullish formation. Should you want to, you could take a long trade there because you have basically it's not quite a morning star, but this is all like candle theory talk. So you have a hard candle down that was a bullish engulfing. So
okay.
This is a bearish engulfing. So it was a bigger candle than the prior candle, a strong one. And then you have an indecision candle right here.
Okay.
And then you have a bullish candle that actually has a higher high and a higher close right after it. Not a higher close, just a higher high. So I can't use this candle because I need a higher high. It has a higher close, but not a higher high. Okay, so we're not in go mode just yet. So we got to wait for that. Is certainly a higher high, higher close. That's bullish. So what I could do if I cared to was
higher high and higher close related to the candle previous?
That's correct.
Okay.
Candle body goes the square part is the candle body. It goes higher. That's the close. And then the top of the wick is higher than the prior wick. That's the high. So higher high, higher close.
Okay.
And then let's just say, I don't know, just put a stop loss down here. I'll just make some shit up, right? And now we're going to see if this was truly like the pullback, then I probably would have a better stop. It'd probably be like the ATR based or what have you, probably be a bit deeper. And then I'd be looking for the extension upwards. And then I would do a Fibonacci extension trade up to this 618, right? This is a pretty risky trade. It's a 586. In all honesty, would probably have a deeper stop. It'd be an ATR based stop on the hourly. It probably would look something like that, like a nice 3-to-1. It wouldn't be so drastic. So we could just see how it plays out. I wouldn't trade this loose, right? I would be much more precise. Okay. So far, so good. Remember, I don't know what's going on here. We don't have the benefit of hindsight on this one. You got a long consolidation, but still you see how it continues to press up. Made our first target at our what I tend to do on these Fibonacci trades is I tend to take some profit off at the 272. So we got there. Even if I kept it there, that's a 188 to 1 at that target. So I could have moved stop to entry, taken profit off, but it certainly bounced at the 382 and kept going, didn't it? Right, that happened.
Yeah.
And we just used basic candle theory. As soon as it tapped that 382, gave us a strong bullish signal on the candle theory. We're like, okay, really close to 382. I mean, this would have been a successful trade going the old school way.
Can you go back to the start of the trade?
Yeah.
Or you can play it out. That's fine. I want to see where it goes.
There it goes.
Well, all right.
And we didn't know this was going to happen. And, whatever, 6 out of 10 or 6.5 out of 10 of these play out, right? So this is just how that's done. But I can go back to the start so that you can see it.
So now here's a question. Can you pull up the stochastic at that point?
I can. I mean, I don't have it on this chart, but I can add it. You just want the stochastic RSI?
Yeah, the stochastic RSI, and then you've got the MACD there. If you just add the stochastic. But yeah, the stochastics, that's okay.
So there's your MACD, your stochastic RSI, the two top indicators right there, right at the start of the trade, right when that one fat candle popped up. The candle itself is quicker. Indicators lag. So you're always going to get quicker signals on candles, but then you have to know candle theory to take advantage of that, right? You have to have studied candle theory. There are indicators out there that will give you like, hey, this is this formation, that's a that formation. Like I could go to the indicators here and I can type in candle theory and I could just click on it. And that's one that's like some guy made up, and they use candle theory to derive their own signals outside of the indicator that I just have on here, right? So this is his candle theory signals. So when combined with structure, these candle theory signals are very powerful, right? Until then, they're just candle theory signals. But that's like one that some guy just like made up. They actually have, I think they have native ones that are actually really good. Let's see, favorites, my scripts. Let's say, just type in candle. All candlestick patterns this is native to the platform.
Okay.
So I can type in that and it's going to give you bullish engulfing. It's going to give you a doji, bullish engulfing. It's going to give you hammer candles, bearish engulfing.
What did it give on the trade?
What's that?
What did it give on the trade?
Is a doji. Remember how I called it like a dragonfly doji or like a spinning top doji?
Yeah.
So it's a doji. So it gave you that on there. But
then the doji is indecision candle, correct?
It can be, not necessarily. It tends to be, but it doesn't have to be. You can get like dojis that are directional, but they tend to be either indecision or just like low volatility, or they can reflect a lot of things. I would not simply categorize dojis as indecision, but most indecision candles are dojis.
Okay.
But candle theory is an entire dude. You don't want to try playing with these like automatic indicator tellers, because I can tell you right now, as far as I can see, it only tells you like a few different kinds. Okay, we got dark cloud cover, doji star. Okay, you can add more on here, and that's good. Hanging man, harami cross. Yeah, this is great. You got all these different ones. If I start like tagging these all on here, you might start to see like a lot of different stuff. I know a lot of these I have very like memorized. You know what I mean?
Mm-hmm.
So you have like this is all the different ones, like LLS, the fucking long lower shadow. Okay, I know what that means. The long lower shadow, I think, is a doji, but it's a bullish doji. Long upper shadow. Yep. It actually isn't a doji. It just shadow is another word for like wicker tail. So it just like a long shadow on a candle is telling you that like a long upper shadow on this candle right there means that the bulls tried to buy and then they got crushed back down by the bears. So if the next candle is bearish, and it is in this case, then you're looking at a possible move down, which actually happens. So the next candle here has a lower low and a lower close than this candle.
Is that also known as a hammer?
The second one is maybe. There's a tad bit of subjectivity there. Like this one right here, definitely a hammer. But the problem with it is that it doesn't exist anywhere that matters. So hammers are going to matter at the bottom and the top of a run.
Okay.
Right. So, but yeah, like, like this is a doji. This is an indecision candle, spinning top doji. This guy right here, the body of it is in the middle of the tails more or less. So it's kind of like market doesn't know what to do. But when you get the bulls try to buy in and get slammed back down like that, and then the next candle has a lower low, lower close, then you're looking at, the next move down. I covered some of this in our classes. I covered basic candle theory in our classes. Yeah. But we don't really use candle theory in this kind of trading that we do. So it's not, if you want to manually trade, sure, go for it. Nowadays you can use candle theory because right now you see it's coded on here. I don't know. I just don't know how good it is. I haven't tested it. And there's a lot of different ways to use candle theory. Like candle theory, this just identifies candles, right? So what matters with candle theory is what happens after the candle. You'll see this kind of candle, and the next candle after that's going to tell you what happens. You see? So you might get a bearish engulfing, but the next candle goes higher than that bearish engulfing. Doesn't matter.
Give me a second. How can I help you?
Hi, sir. My name's Caden. I'm the manager with Moxie. The only reason I'm stopping by, I've serviced 6 of your neighbors, Anthony, Patricia.
Yeah, we're not interested right now because I'm redoing a full rehab.
Well, right. Give me a couple seconds to tell you what I'm on.
I don't have time. Sorry, I'm on a call. Thank you. Sorry about that.
Yeah, it's tough doing door to door. I've done it. You gotta kind of. There's a way to do that. Yeah, it's just. But yeah, look, candle theory is something where you really got to know what you're doing. Probably, I don't know, half of these I know what they are. I don't know what a Tauski is. I know the tweezers top, tweezers bottom. I don't know what a TriStar is. I know what the white soldiers and black crows are. I know spinning top. I don't know white and black. I know shooting star. Don't know rising window. Don't know the 3 methods. Don't know piercing. Don't know on neck. I know morning star, morning doji, which we actually saw a morning doji in the trade that we simulated was a morning doji star. Now, did this identify that?
No,
I don't think it did. It just marked it as a doji. But a morning doji star is, it's actually really, okay, so that's the tough part. Like, I saw it as a morning doji star. I knew, though, that this candle needed to happen for it to technically be a morning doji star, right? But that candle happened afterwards, which validated it as a morning doji star, but technically is not a morning doji star, meaning like it didn't fit the criteria for the formation, but it's going to behave the same way as the formation. So because I understand candle theory, because I traded it for years, like I can look at that and go, it's time to go in. But your computer would not have seen that.
Okay.
So if you're going to be a candle theory trader, you need to be a candle theory trader. And this is the problem with like a lot, like almost all traders, is that they see a new toy and they want to go play with it. They think it's going to make them rich. Now, here's the thing about trading. I heard this. Look, I've been doing this for years, and I still listen to stuff that you would think is beneath me or whatever, right? Like I listen to things that you might consider to be elementary. I was listening to a trading psychology podcast, and the guy said it so well. He goes, you're going to create a new algo, you're going to create a new method, and you're going to think you have it. You're going to think you've got it. You're going to think that you're going to get rich, but the reality is you'll never have it. It's never going to happen. You will never have the holy grail. You'll have something that goes really well for like 4 or 5 trades, and you think you're God, and then all of a sudden the next day you lose everything. You're never going to have it. So what you have to do is you have to do the work. You have to create your algo. You have to back test it 20 times to see if it's viable, back test it 50 times to see if it's viable to the second order, back test it 200 times to get your basic numbers. And when you do that, you're going to see, hey, I lost 38% of these. And I even have losing streaks of 4 in a row, right? And once you've done that, it's like, oh, well, okay, this is profitable. It's not the holy grail. Not every trade is going to win, but this is profitable. So then as you forward test, you're going to then see with a much lower risk, like without using a lot of money, you're going to see those numbers be realistically played out because it's all your back testing always is subject to overfitting and technical limitations. And your back testing is never going to be accurate, to like 100%. Like your back testing will never be accurate to a realistic degree. Live testing is only the thing that's going to give you that, and live testing with real money on the line, even though it's a small amount of money. So with that said, you forward test, you get your real probabilities. You now understand that yes, you will lose a few in a row at times. You will win a few in a row at times. It's not going to kill you, and you're not God. And then you trade. And what most people have is their mistake is they have a sense of urgency that they need to make this money next week. They need to make this money next month. They need to have it by the end of the year. And they spend 4 years jerking off and like never getting it done because they don't want to go through the testing. They don't want to go through the forward testing. You find a new toy. All of a sudden they want to do candle theory. Oh, that didn't work for a month. I'm going to try this. I'm going to try that. It's not how it works. And professional traders fall prey to this. This is not a new trader thing, but it is mostly a new trader thing. You need to find something that is profitable. You need to play that out until through the back test. You need to play it out through the forward test. You need to trade it every day. You need to take your lumps. And you need to just get profitable, get deployed. Now, once you're deployed, then you start your new toys, and then you back test that, you forward test that, and you deploy whichever one is the most profitable. There's no shortcuts to this game. And everybody wants to use AI, and they're all going to lose too. It's just anybody who doesn't want to go through the process is going to lose.
Well, it's tuition.
Yeah, but you get the choice of whether your tuition is small or large. You get the choice of whether your tuition can be minimized, your time spent, which is more worth more money than you lose. You just got to be a robot, and you got to understand that there is a process and you have to apply the process. And it's the hardest thing that people don't do. You deploy, you start entering early because you entered early and you want to trade. It's like, oh, I can enter early now. And then all of a sudden you lose like 6 trades because you entered them all early. You got to follow the rules, man. Don't get greedy. It's like, oh, I think this trade's going to happen. All of a sudden it starts to go in your direction. It's running away. Like, oh, and then you get in and then it stops you right out, Or you bet early and you won 2 in a row. Like, oh, I can bet early on this one. I can bet early on this one. And you win a third one, you win a fourth one, you're like, oh, I've got it. I'm fucking genius. I got 3 trades in 4 days. I went in early and I got 3 to 1. And then you're like, I'm going to go in early on every trade, and you do it and you lose like 6 trades.
Yeah.
So you got to just follow the rules, man. You just got to follow the rules. This is not a gambling game. It is a gambling game. But what I mean to say is you can't gamble on your rules. There's always an X factor. Let me put it this way. This is not a gambling game. This is a probabilities game, right? So you go to Vegas, you're gambling because the odds are against you in every single game, with maybe the exception of poker. And if everybody's playing poker without playing any mind games, then the odds are like the same for everybody, except for you're always paying the house a little bit, right? So the odds ultimately are against you. Even in poker, you can turn the tables with mind games. But that's like the only place you could do that. It's poker, like Hold'em or something. But everywhere else in the casino, odds are stacked against you. You will lose over time, right? So that's gambling. In this game, the odds are going to be something you determine within your capability. So you're able to boost the odds away from 50-50 by using technical data, scientific analysis, data mining, if you will. And you can understand that you can tilt the odds just a bit into your favor. But you have to, when you go to a slot machine, you don't pull the handle a special way, Oh, if I jerk the handle a little bit harder, I'm going to win. Like, that's not how it works. Or nowadays, the button, if I hit the button really hard, I'm going to win. No, it's just like the same thing. It doesn't matter how hard you hit the button. It's going to spin the same way every time. You need to be the button, except that the slot machine's tilted in your favor, but you're going to hit that button the same exact way every single time. You're going to enter the trade the exact same way every single time. And if your rules don't get met, you do not enter the trade. Got to be a robot.
Yeah.
Being greedy doesn't help you win on the slot machine any quicker. Why would it be any different with this?
It's not.
It's worse in a way, Being greedy can cause you to make a mistake. The slot machine, you just hit a button. You can actually make it worse with greed. So, that's a bit of a talk on psychology for you. So we did cover a lot here. Let's give Reagan a chance. Reagan, I hope you were absorbing some of this. I know some of this may have addressed some of your questions, but Reagan, do you have any questions?
Not yet. I mean, I'm just kind of learning right now. So yeah, thanks for going through all the technical talk. And I think the psychology aspect of it was good. Stick to the rules and, focus on your trade and focus on the process and not trying to play with new toys.
Don't even look at your P&L. Don't look at your profit and loss. Your account has a better chance of growing if you don't look at your profit and loss. Like you always risk, so we do money management where you only risk maybe 2% of your book every single time you trade. Doesn't matter if you think it's a miracle trade, doesn't matter if it's a shitty trade. There's a little variance once you become more sophisticated, like, okay, I might bet 1.8 on this trade because it doesn't meet all my qualifications, but it meets enough qualifications to take the trade, or it might be, hey, this trade is like has these qualifications plus an extra boost from these extra. You might go like 2.2%. Like you can start to play a little bit, but you're going between 1.8 and 2.2%. I mean, you're just barely juicing your algo based on rules, and they're the same rules every single time. Okay. So there is like, once you get sophisticated and you've live traded and you've determined some rules that can sort of bend profits in your favor and bend losses away from you, there is a little play there, but it's always rules based every single time. There's always a rule. And when you only bet 2% of your book every single time, that's going to control the size, let's just say that'll control the pace at which your account will lose if you go on a bad streak. And the best algos, the best methods all go on bad streaks. It's just what happens. So there's training psychology. There's, like I was telling somebody today about that. Like you could have the best algo in the world, but if you're not practicing all the right things, you will lose all of your money, even with the best algo that anybody could ever make. Because you haven't hired a coach. That's why. Somebody who's been through it, somebody who watched their account balance rotate around the same number for 2 years because, mental masturbation. Larry, do you have anything else, my friend?
No, I'm good.
Well, we're on the hour, so it's good to have you guys. It's kind of cool. I got like a newer guy. I've got Larry. At this point, you're starting to become a bit of a veteran, at least in the building process. You certainly understand that, and I've seen you winning trade after trade. Like I know you built good algos. So, I'd start to call you a veteran in certain respects, right? After a few years of success, we can call you a legit veteran.
No, not yet. I'm taking my lumps now.
Yeah, well, we all, dude, I take lumps. Like everybody takes lumps. Even your best traders take lumps, which is why automation is like really a lot better if you can do it. And we're working on that too. We're, Algo Factory is going to roll out some way, shape, or form of agentic AI bot building, right? Like the tech's there now. And I just want to make sure that people are doing it in a way where they're not just trying to skip forward, because they'll lose. You're going to lose. You're going to lose. If you skip the basics, you're going to lose. The bot building is there now. If there was a way that you could just not know anything about trading and say, hey, build me something, that they would be doing it. People would be making millions of dollars without knowing anything. They're not doing that. They're not ever going to be able to do it.
No, not with the way the market is.
The market will capitalize on them immediately. So, well, thank you all for watching. I'm going to catch you next week. Larry, you and I talk, we have a one-on-one. Is it Monday?
Monday, yeah. I got to do my back testing, and then I need your help optimizing.
Okay, well, let's do it. Yeah, for those of you, algofactory.tech. So go ahead and, if you're interested, you want to know more, go to algofactory.tech. Reagan, do you know like how to find my stuff, like my videos and such? I think Reagan might be on mute.
My screen's freezing up for some reason, so thanks, Nick.
Sure. Do you know how to find like my materials and stuff on YouTube?
Is that the Algo Factory? Is that your like YouTube page?
It is, yeah.
Okay. Yeah, I'll check it out. I'll check out the channel.
Here, do this. This will make it easy for you. I'm going to grab a link and I'm going to put it in the chat for this Zoom. Give me just a second to find it. Okay, there's the Zoom. You know how to look in the Zoom chat, do you?
Yep.
Just put a link in there. So if you use that link, and I give away like a free algo. So it's a really basic algo. What's more important about it is not its profitability, because technically it's profitable. You would have to optimize it. You can't just use it. But it's it's like a 15-minute video where I actually build an algo, turn it into code. I show you how a lot of it's done.
Okay, great.
So that'll kind of take like, a few months of time off. And then if you want, you could just go to the YouTube channel and that'll lead you, to it. No, it won't actually. That's not true. I'm going to put you on, I'm going to send another link of just the live video that I did like earlier today. And it's a YouTube. You can just look on there and explore. So that's the second link. That's the YouTube. If you have any questions, Reagan, just hit me on, on School or on Signal. I'll be happy to answer them.
Oh, all right. I appreciate it, Nick. Yeah, I'm going to just take some time to kind of absorb it and get used to, this jargon and everything and how it all works. And
There's one way to do that. There's one way to do that. One way and one way alone is osmosis. Trading is such a large subject that if I made videos to teach every way there is to trade, I would make videos for the rest of my life, and I'd have to pass it on to my great-great-grandchildren because it's a massive subject. So when you start to get into trading, you kind of have to choose a path. We put you on a path. So like we work with beginners. We were, Larry, you had a little bit of a head start. I know you had done some trading before. I bring in people who have never traded. So, they learn the jargon as they go. The key is going to be that you have to see enough, whether you want to work with me or another coach or no coach, you have to see enough to where you understand enough to where it's like, okay, I think I could do this. But you can't be like, Well, Reagan, well, I don't want to reveal too much personal info, but let's pretend you're an engineer for a moment. Engineers, I almost don't want to work with them. I can. But the problem with engineers is they want to know exactly how everything works, and they want it to work perfectly every time.
Yeah.
That's not how this works. You're never going to know how it all works, and it's never going to work perfectly every time. Right? Gamblers, great traders in a way, but sometimes I don't want to work with gamblers. You know why?
Because they
don't want to know how any of it works. They just want to roll the dice and be like, yeah, just give me the algo. Like, no, get out. Right. But somebody who might be somewhere in between.
Gotcha.
A little bit of engineer, a little bit of trader, enough to understand probabilities, enough to be willing to have a little risk in the game. Like, these are the people who are going to make it. So if you're the kind, like, it's the same with sales. I never were, when I was in sales, which I did for many years, if somebody told me they were an engineer, I'd be like, I'll call you, don't call me. I don't want to talk to engineers in sales because they want to know how every little thing works. So you got to be willing to sort of take a leap without having to know every little thing. And you will learn what you need to know via osmosis. So you understand that part.
Gotcha. Okay.
All right, gents.
No, see you later, Nick. Thank you.
See ya. Yeah, no problem. Catch you guys later.
Bye.